In Chapter 3, we'll be going over the Chapter 3 lecture notes and also the Chapter 3 budgetary accounts. So for the Chapter 3 lecture notes, first, let's just review what we talked about in Chapter 2. We talked about the fact that governmental funds have to create financial statements, proprietary funds have to have financial statements, and fiduciary funds have to have financial statements. Now, remember, governmental funds use the modified accrual basis of accounting. These three financial statements are going to be combined together to create the government-wide financial statements. Now, remember that we're still talking about state and local governmental accounting. And this week, we're going to focus on here, governmental funds. So for governmental funds, we're going to be talking about the different types of revenues you can have, expenses, net assets, and we're going to also talk about budgetary accounting in more detail. First, a couple of terms. The fact that everything is done twice is called dual track accounting. It means that financial statements are done at the fund and government-wide levels. If you look here, you can see that we have financial statements that are created at the fund level and also at the government-wide level. Full accrual is used by the government-wide financial statements, proprietary financial statements, and fiduciary financial statements. Modified accrual is only used by governmental fund financial statements. As you can see here, governmental funds use the modified accrual. Okay, so let's go ahead and talk about governmental funds. So this is a roadmap that we're going to be using for this lecture here. We're going to talk about fund balance. Okay, so fund balance, this is for governmental funds. There's 5 types of fund balance. We're going to be talking about revenues, exchange and non-exchange. We'll go over expenditures. This is less important, but we'll talk about the different types of expenditures that governmental funds can have. And this is the most important thing, we're going to go over budgetary accounts. Okay, so if you look at the fund balance, if you look at the balance sheet, this is the financial statement created by a governmental fund. If you look at the balance sheet, the governmental fund has 5 types of fund balance. So you can see here non-spendable, restricted, committed, assigned, and unassigned. Now, non-spendable fund balance means something that is just used up. Look at the examples that we have here. We can have inventory, prepaid expense. Those are things that aren't cash related. They're not cash itself, I should say, but they're used up in the course of a business. So fund balance is like stockholders' equity. Here we have 5 different types of stockholders' equity. The first one is non-spendable. Next, these 4 types of fund balance can be understood by looking at the bottom item, unassigned, assigned, committed, restricted. Let me give you an example. Let's say that you have money that can be used for anything. So it's discretionary. That means it's not earmarked for any purpose. It can be used for whatever you want. That's called unassigned fund balance. Let's say that you're thinking about buying a car. You're not required to do it, but you think about it. I think I might buy a car. That's called assigned fund balance. What about somebody on the inside saying that you're going to buy a car? That would be committed. So if you are the city of Rockville, if the CFO says that they're going to buy a fleet of new vans, then that's somebody inside the government saying that they're going to do something. That money has been committed. What about if somebody on the outside says that you need to spend money for something? For example, let's say that the federal government says that you have to set aside $100 million for education. That's somebody on the outside telling you how you have to spend your money. Those types of fund balance are called restricted. Okay, next, let's talk about governmental fund revenue. Okay, so for governmental funds, you can have two types of revenue, exchange or non-exchange. Now, exchange revenue means that you have some type of reciprocal transaction. That means that the government receives money and provides you with a product or service. Okay, so some examples of reciprocal transaction, exchange transaction, would be like a county parking garage. When you go to a county parking garage, like in Bethesda, you're paying, let's pretend, $2 per hour. So you're paying money to the government is receiving revenue, and they're providing something to you in exchange. They're providing you with a place to park. That's called exchange revenue. Non-exchange is where you have no reciprocal transfer. The classic example is taxes. If you have to pay taxes to the government is getting revenue. They're getting tax revenue. But they're not really providing anything for you specifically for those taxes on the surface, right? You could argue that you pay taxes so that the government is going to provide you with snow removal in the wintertime. They're going to maintain the street lights. But the point is that the government is charging you taxes, and they're not at that moment explicitly giving you something back in return. That's called a non-exchange revenue. Only the government can have non-exchange revenue. And there's 4 kinds of non-exchange revenue. There's imposed, derived, government mandated, and voluntary. Let's go over each of these together. Imposed non-exchange revenue basically means that you're minding your own business, you didn't buy anything, you're just being a citizen, and you have to pay imposed non-exchange revenue to the government. Okay, so examples of imposed would be property tax. I own a house, so I didn't buy my house this year. I didn't sell my house this year. I'm just living in my house, and the government says, "Well, I have to pay property taxes of $7,000." That's an example of imposed non-exchange revenue for the government. What about a penalty? If you pay a penalty, right, or a fine, like if I park my car in front of a fire hydrant, I was trying to mind my own business. I wasn't trying to do any transaction with the government. I just parked my car, and the government says I have to pay a penalty or fine. That's imposed on me. That's imposed non-exchange revenue for the government. Derived means that there's some kind of underlying transaction. For example, sales tax. So if I go and buy a pack of gum, or if I buy groceries, there's an underlying transaction. I'm actually buying groceries. Then the government is going to charge me 6% sales tax, and they're going to keep that money. Now, I bought the groceries from Safeway, So Safeway is the one providing me with the groceries, but the government is seeing that there's a transaction here. I'm buying groceries, and they're charging 6% sales tax. We call that derived non-exchange revenue. Government mandated is typically when the federal government gives money to a lower authority government. For example, the federal government may give the state of Maryland $5 million to maintain the highways that go through Maryland. So the federal government is not giving the state of Maryland a choice. They're saying, state of Maryland, you take this money and you must use this money to maintain the highways that run through your state. That means that the state of Maryland is getting government mandated revenue, non-exchange revenue from the federal government, and they must use it for a specific purpose, right? So the money must be used for a specific purpose. What's voluntary non-exchange revenue? That's when someone gives money and the state or local government can decline it. So the federal government might tell the state of Maryland, we have some grant money. If you want to provide vaccine research for your Department of Health and Education, then we'll give you the money. But if you don't want the money, you don't have to take it. That's called voluntary non-exchange revenue. Next, you should know that for governments, expenditures appear on the statement of revenues, expenditures and changes in fund balance. And expenditures can be by function, that's overall purpose. For example, I give you an example here of public safety. Or expenditures can be very specific. For example, object. So that's salaries and wages. Okay, so you can look at this yourself and just know that expenditures can be either very broad, like function, or very specific, like object. Okay, so we're going to talk about budgetary accounts and budgetary accounting. So here we have a handout, and what you need to know is that when you are doing accounting for governmental funds use the modified accrual basis of accounting, and they use budgetary accounts. So budgetary accounts simply provide more detail. It's an extra step. So there's a lot of budgetary accounts here, so you can take a look at these on your own. But the most important ones are these four here. These are the most important budgetary accounts. All right, so let's take a look at some journal entries. So this is pretty difficult when you look at it for the first time, but after you do it a couple of times, you'll see that it becomes a little bit easier. And whenever you have these types of problems, they're always basically the same. Here, it says we have a budget that was adopted, and estimated revenues are 3.25 million, and appropriations are 3.2045 million. If we were going to do full accrual basis of accounting, there would be no journal entry. If you think you're going to get revenues of 3,250,000 and you think you're going to spend, that's what appropriation means. Appropriation means how much you think you're going to spend. If you think you're going to spend 3,405,000, full accrual basis of accounting would say that there's no journal entry that you need. But if we do modified accrual, if we're doing budgetary accounting, we're going to make the following journal entries. How much revenue do you think you're going to get? 3.25 million right here. So look at the sheet here. Estimated revenue. When you have it, you have to debit estimated revenue. Okay, so we're going to debit estimated revenue, $3,250,000, and we're going to credit not retained earnings, not fund balance. This is a budgetary journal entry, so we call it budgetary fund balance, and that's for $3.25 million. How much money do you think you're going to spend? $3,204,500. That's appropriation. So how would you make that journal entry? Appropriation you would credit. Okay, so we're going to credit appropriation, $3,204,500. And if you have appropriation, if you think you're going to spend that much money, it's basically making your budgetary fund balance smaller, $3.24500. Okay, so these are the journal entries that you would make. These are budgetary journal entries. What about revenues? If you have revenue of $3,256,500, it says were received, so we assume that you got the cash. You debit cash, $3,256,500, and you have revenue, credit, $3,256,500. Okay, next, it says purchase order, $1.69 million. Okay, purchase order, so you order something. Okay, so if you're going to order something in governmental accounting, you have to set the money aside. So if you ever go on vacation, maybe you have like a vacation fund. Or if you're going to buy a new TV, maybe you have a coffee can and you set the money aside, right? Sometimes I'll order pizza and they'll tell me it's going to be $20. So I take $20 out of my wallet and I put it on the table. I set the money aside. In accounting, how do you set money aside? If you use budgetary accounts, you're going to use encumbrance and reserve for encumbrance. Very, very important. So what you do is you debit encumbrance control. Now the book uses a slightly different account. They say encumbrance control, budgetary fund balance. It's a longer account, but you can use the book's journal entry account or this one. It's basically, not basically, but it's exactly the same thing. Then you credit budgetary fund balance, reserve for encumbrance. Okay, 1.69 million. This is when you set the money aside. Next, what if you receive your order? Okay, so how much of your order did you receive? It says purchase orders were filled in the amount of, this is how much of my order showed up. It was 1,436,500. Now, the bill, the invoice says how much do I have to pay? 1,443,000. Okay, so remember in step 3, we set money aside. And in this next step, we're paying 1,443,000. So how would you do this journal entry? Well, if you set money aside, you make this journal entry. So if you take money off the table, if you take money out of what you set aside, what you're going to do is you're going to just reverse this journal entry. So budgetary fund balance, reserve for encumbrance. How much are you releasing? It's this amount. Okay. And then it says you have an invoice for $1,443,000. So if you have an invoice, you have expenditure because it's saying pay this bill. So it's an expenditure, it's not an expense. The reason why it's expenditure is because this is modified accrual basis of accounting. Okay, so expenditure. And then you're going to credit vouchers payable, or you could just say some kind of payable. You just got the invoice, you just received the invoice, you didn't say you paid it yet. Okay, and then that is the journal entry. Okay, let's take a look at this one here. This one says expenditures not encumbered amount to $1,352,000. Okay, so that means you just have regular expenditures. It says it's not encumbered. In other words, you don't have to make this funky journal entry here, right? So it's not encumbered. So if you just have regular expenditures, what would you do? Regular expenditures. Then you would just say debit expenditures. And you would credit, it says not paid yet, so vouchers. Or you could say accounts payable. Okay. Finally, what would you do when you pay the amounts in D and E? Okay, so how much payable do I have in D and E? Okay, so I have in D, I have this much payable. And in E, I have this much payable. Okay, so how much do I have to pay? $1,443 plus 1,352. $2.795 million. Okay, so you're going to debit vouchers payable. $2,795,000. And you're paying, so you're going to credit cash $2,795,000. And that is the answer. Okay, so you can see in this chapter for chapter 3, what you need to know is basically summarized here. Make sure you know the different types of fund balances that you can have. Right? You can have non-spendable, restricted, committed, assigned, unassigned, which is listed here. Make sure you know that revenues can be either exchange or non-exchange, and the exchange revenues are imposed, derived, government mandated, and voluntary. Also know that you can have different types of expenditures, right? And expenditures can be either categorized very broadly by function, or you can be more specific and use object. Finally, know that governmental funds do some budgetary accounting. So just know this example here in problem 1.